Jake, thank you so much for joining us today to help us understand the stock market in these crazy times. We are seeing increased and wild volatility in the stock market over the last month. What does this point to?
Well, the stock market itself has been in a wild swing for about 12 years. We have been basically going up and down and up and down, and at the end of the day, we haven't made anything in about the last 12 years. The media's called this the lost decade. The last month has turned extremely volatile. 10 of the last 30 days have seen 100 or more point swings in the Dow. And the crazy thing is that 5 of those 10 swings were up and 5 were down. So we're getting to what looks like what they call an inflection point in the market, where we might see a big move here in the next couple of months. Our opinion is, if you look back at the trends of the stock market, you look at the Dow Jones Industrial Average over the long term, there are long-term trends, and we're in the middle of one. 1966 to 1982, the market went sideways, and it was highlighted by these trends of wild volatility right before a sudden move. So we would expect to see maybe a correction coming in the next, say, 2 to 4 or 6 months. The reason being, the market's gone straight up for almost 50 months. The average bull market lasts about 56 months, so just under normal timing, we would expect to probably see some sort of a pullback or a correction. So this volatility, while it seems unusual to the spectator because it's so wild, is actually normal if you look back over time. The same thing happened from 29 to 54 after the Great Depression. We were spiking all over the place commonly like this.
I have also read a lot lately about the risks in bonds when interest rates go up. Has this been happening in bonds markets?
Yeah, the bonds have probably even been maybe crazier than the stock market if you look at the last few weeks. One thing about that is that the average investor doesn't always know this, but when interest rates go up, bonds lose value. So what happened in the 10-year Treasury, which is the benchmark really for all interest rates in general, that's what all the traders look to. The 10-year Treasury has gone from 1.8% to 2.2%. Now that doesn't sound like a lot, that's only 0.4%, but that's a 22% shift in just a couple of weeks. People are going to be opening their bond statements from their brokers and realizing they've actually lost money in bonds if we continue in this. To show you the volatility and how important it is, in Japan a couple of weeks ago, their 10-year Treasury bill came up to 1%, which is historically very low, and their stock market lost almost 9% in just one day. And the reason is the bond traders are getting very, very nervous about what's going on with the large amounts of debt. So it's worse in Japan, it's bad here, and it's bad around the world, but the bottom line is the bond markets are getting very, very jittery. Most of the experts in this environment are looking to the fact that the bond markets might even get more volatile than the stock market. So it's going to be a crazy ride in the bond market as we see it, maybe even more than the stock markets. It'll be interesting to watch the next couple of weeks, but bottom line for investors here is be cautious in bonds, because when rates go up, bonds lose money.
Thank you. Any final thoughts?
Yeah, the final thoughts would really just kind of be aware of what's going on and realize we're at the end of the trend. Don't listen to the media too much, because if you turn the TV on, you would think it's all hunky-dory because the market's gone up for 4 years straight, and indeed it has, and it has been good if you're a stock market investor. Your 401k has made back all of its losses of the last 4 or 5 years. But the bottom line is the market never goes straight up, and it will have a correction. I don't claim to know when it's going to be. We just are pretty sure that it's shorter rather than longer as far as where we're at right now. So we would expect to see something in the imminent future, being in the next 2 to 12 or 14 months. So be cautious, realize we're near the top of the trend, and invest accordingly. You've got to look outside the box and look for other ways to get a safe yield today. The market's risky. The stock market's risky, bond markets are risky, and the bank is paying nothing, so you've got to look a little deeper in today's environment.
Thank you for clearing those questions up for us.
You're welcome.